With the political developments going on in France, investors are rightly concerned about the exposure of Eurozone banks to French government bonds. So it's a good thing that we have with us today the full European bank credit team. That is Ruben, Benavides, and Jeroen, Julius. Ruben, you've done a lot of work on this. What can you tell us about European banks' exposure to the French government?
Thank you, Renato. Pleasure to be here. So, as you may know, banks are large holders of government debt and are often seen by investors as a proxy of sovereign risk. So, every time there is political uncertainty, banks tend to suffer. This has been particularly true for Italian banks in the past and more recently to UK banks, and this time is no different with French banks. So, we thought it was an interesting exercise to run some numbers and understand the actual exposure. According to the latest available data by the European Banking Authority, EU banks under our coverage hold 2.2 trillion of sovereign bonds, of which almost 25% is French government bonds, which is higher than any other country. And surprisingly, French banks had the highest exposure, representing between 5 to 15% of their total assets. The question mark here is if the increase or the widening in the French sovereign could trigger a material or significant impact in regulatory capital for EU banks. And our take is that direct impact might be limited, as banks book their holdings as amortized cost, which means they don't need to market their losses, and they can just hold the bonds until maturity. But for further details and more specifics on the regulatory capital impact, please refer to our bio, where we have different notes on this topic.
Jeroen, I know French banks are a central part of your bank coverage. What should we be aware of from a credit ratings perspective?
Hi, Renato. Yeah, so in October, Moody's changed the outlook on the French sovereign to negative, and also put seven French banks on negative outlook, and that reflected the weakening capacity of France to support the country's systemic and strategic banks in case of need, quote unquote. And that reflected the deteriorating fiscal picture in France and the risk that the government is not going to be able, perhaps, to implement measures to prevent a sustained weakening of the country's debt affordability. Now, yesterday's events in France will not have helped that outlook. So it's important to note that Moody's still factors in a moderate probability of support in the senior unsecured debt ratings of the systemic banks in France, one notch. So that notch is likely to disappear if the negative outlook on the sovereign rating is going to result in a rating downgrade. Now, Societe Generale had already been put on negative outlook by Moody's earlier in the year, back in May, but that was due to the bank's poor earnings. So now BNP and Crédit Agricole are also on negative outlook because of the change in the sovereign outlook. So that's Moody's, and then you also have Fitch, which moved 2 weeks before Moody's did. Also a negative outlook on the sovereign, but Fitch has been quite specific, stating that BNP and Crédit have sufficient rating headroom to withstand a one-notch downgrade of the French sovereign. So Moody's, if it's going to be a downgrade, should mean that the senior unsecured ratings of BNP and Crédit will come down by a notch. If Fitch's negative outlook on the sovereign were to result in a downgrade, that should not lead to a downgrade or to any changes in the French bank ratings at the moment.
Right. And how do you see that translation into bond performance?
Well, look, it very much depends whether this is it or whether this is the start of more negative rating action by the rating agencies. I think it's important to single out Societe Generale Tier 2 bonds and all this. Again, the negative outlook on SocGen is predicated more on the standalone creditworthiness of the bank, the profitability challenges that it faces. If you look at the at where the tier two bonds are rated of SocGen, they're at Baa3, triple B minus, triple B. So if the Moody's negative outlook were to result in a downgrade, the composite rating on those bonds would still be high grade, but the scope, the buffer, if you like, is starting to get quite narrow. Additional tier one bonds, slightly different story. They are high yield for SocGen. They are investment grade for BNP and Credit Agricole. But as you know, AT1s aren't in the main indices, and they're not typically held by investors that are rating constrained. So the rating impact, if you like, on AT1 performance is less obvious.
Right. Okay, perfect. Thank you. Thank you so much, Ruben and Jeroen. I will strongly recommend everyone to follow their bios on the terminal. There's a little bell sign that you can subscribe, where you can subscribe to their research, and make sure you get it when it gets published. Thank you very much. See you again soon.